if the slope is undervalued, the puts are undervalued. That's how you read that. And the earnings month. So we actually highlight which month is earnings and say whether that's over or undervalued. Here, most of the at the monies are slightly undervalued, but since the earnings is overvalued, it weighs into that and it makes it a neutral, or goes up a tick from undervalued. So let's look at the actual sheet. So here are the 12 sheets, including value vol. You would input a name, Microsoft, and say run current, and it goes and updates that information, and then Intel INTC, and run that, and it goes and gets current information. And again, we've seen this. And now let's go through what the actual underlying factors of the short-term implied volatility, the long-term implied, the slope, and the earnings, in order to get to these or what we call our standard deviation readings that then feed into the table for the valuation. So what we'll do is we'll average these, and it's not exact average, we're averaging standard deviation. So mathematically you turn it into a variance and average that and turn it back into a standard deviation is how it actually works. And we actually have the formulas in here if you're interested. So let's look at underneath the short-term implied volatility sticks. Let's look at the first of the four factors that we look at to value the short-term implied volatility. ORATS does a forecast of the individual stock and ETF. We call it the ETF forecast relationship. So basically what we'll do is we'll look at Intel, the implied volatility divided by our forecast for Intel is 0.9. And then we say what the actual number is. 21.5 divided by 24.9 is that 0.9, and the XLK is 11 divided by 13.1. So you would compare the 90%, so the implied is a little bit high in Intel compared to XLK. That's why we get a standard deviation reading positive. Sell the positive, buy the negative is basically what this is saying. And then we will compare that relationship for the short term. So the current short term IV HV compared to the XLKs. Now this is different from the implied divided by forecast. This is implied divided by historical volatility. So we'll do the 20-day implied X earnings, the 20-day historical X earnings, and compare that to its most related ETF and come up with that relationship. And again, it looks like the implied is slightly higher in relation from Intel to the XLK. But then we'll compare that ratio. We'll compare that to where that ratio has been historically. Now that ratio historically is usually above 1. It's been 1.2, and so it's actually that ratio of 1.4 is actually showing that is slightly undervalued. So that's where that reading comes from. And then the final of the four valuations for the short term, we look at the ORATS tick volatility. So the ORATS tick volatility looks at simulating scalping gamma and turning that into a volatility. So it's more of an intraday measure compared to a close to close, which is a one time per day measure. And the thinking there is that if that intraday measure differs from what the market usually looks at, the close to close, then that might signal an under or overvalued situation. And in this case, it's actually quite telling that the tick vol is much higher than the close to close, so we think that produces an undervalued, pretty large undervalued situation. Okay, so let's drop down and look at the long-term volatility. The long-term volatility is neutral to undervalued for Intel. We do a long-term forecast, and in similar fashion we compare that. The relationship of 1.1 is lower than the 1.2, so that's a small undervalued reading. The implied to historical, as we did above, also is undervalued as compared to the XLK. And then we do the same tick close to close, and that's also undervalued. So we would say that the LIX is undervalued. The put call slope, we do a forecast of the slope and find that Intel is under, whereas the XLK is over our forecast, so that comparison is an undervalued situation. The puts aren't as high and implied relative to the calls, out of the money calls, out of the money puts, so we can communicate that as an undervalued situation, and that the slope for the month has been 2.3%. And what that 2.3 is you could think of it as the 50 delta might be 100 volatility, and if it was 2.3, then 102.3 would be the 60 delta implied volatility. And so that is under the average for the month. And then the ratio of the Intel slope divided by the ETF slope is 0.4. Due to rounding, that's slightly undervalued as well. And finally, we look at earnings. We look at if the implied earnings effect is above or below the forecasted earnings effect. The forecasted earnings effect is how much the stock actually moves versus our predictions of volatility on earnings, and the implied is how much the months with earnings are above the months without earnings. So for example, the earnings month is here, it's the third month, and you could see how the volatilities go from 21.8 up to 23.8. So that step up is we attribute that to an earnings effect, and that's a pretty big earnings effect there. It's 327%. What that means is we would expect the stock to move at 327% of its normal move on the day of earnings in order to make up for that large increase in implied volatility on the earnings month. So that tells you that's how we determine the valuations for the table based on the 4 valuations of the slope, earnings, and short-term and long-term volatility. What you can also do is input a stock list here, and these correspond to the readings in the actual individual value vol. And if you wanted, you could sort these and identify value vols with certain characteristics that you might be looking for. Again, you could input any list you want. Here I'll delete a few and update the list, and so it'll go ahead and update this list for the current short-term, long-term put call slope and earnings implied volatility. So that'll do it for the value vol. Just to explain a couple of the advantages of using ORATS, we talked about historical and implied volatility. We have massive databases going back a very long time. We were successful traders on the floor before offering our research out. And then that slope simplification is also a benefit where we can normalize that slope and compare it across time frames and across tickers. And we also obviously offer other data files and executables that you could see in the other videos here. So hope you enjoy this API sheet, and there are plenty more videos for you to look at. Please contact me at ORATS with any questions. Thanks.